Question 11. What is the meaning of equity? Answer. Equity is used in accounting in several ways. Often the word equity is used when referring to an ownership interest in a business. Examples include stockholders' equity or owner's equity. Occasionally, equity is used to mean the combination of liabilities and owner's equity. For example, some restate the basic accounting equation assets equals liabilities plus owner's equity to become assets equals equities. Equity is also used to indicate an owner's interest in a personal asset. The owner of a $200,000 house that has an $80,000 mortgage loan is said to have $120,000 of equity in the house. Outside of accounting, the word equity is also used to indicate fairness or justice. Question 12. What is meant by reconciling an account? Answer. Reconciling an account often means proving or documenting that an account balance is correct. For example, we reconcile the balance in the general ledger account cash and checking to the balance shown on the bank statement. The objective is to report the correct amount in the general ledger account cash and checking. You will often need to adjust the general ledger account balance for items appearing on the bank statement that were not entered in the general ledger account. I recall being asked to reconcile the general ledger account freight payable. What I needed to do was provide documentation that the balance in freight payable was proper. I proceeded to look at the shipments of recent sales and then determined how much we would be obligated to pay for the freight on those sales. We then adjusted the balance in freight payable to my documented amount. This reconciliation was done to have the correct account balance and to provide the outside auditors with documentation which could easily be reviewed. I also reconciled the balance in utilities payable by computing the daily cost of each utility that the company used. The cost per day was then multiplied by the number of days since the last meter reading date shown on the utility bills already entered in our accounting system. We then adjusted the utilities payable account balance to be equal to the documented amount. Question 13. What is the purpose of control accounts? Answer. A control account is a summary account in the general ledger. The details that support the balance in the summary account are contained in a subsidiary ledger, a ledger outside of the general ledger. The purpose of the control account is to keep the general ledger free of details, yet have the correct balance for the financial statements. For example, the accounts receivable account in the general ledger could be a control account. If it were a control account, the company would merely update the account with a few amounts, such as total collections for the day, total sales on account for the day, total returns and allowances for the day, etc. The details on each customer and each transaction would not be recorded in the accounts receivable control account in the general ledger. Rather, these details of the accounts receivable activity will be in the accounts receivable subsidiary ledger. This works well because the employees working with the general ledger probably do not need to see the details for every sale or every collection transaction. However, the sales manager and the credit manager will need to know detailed information on individual customers, including whether a customer recently reduced their account balance. The company can provide these individuals with access to the accounts receivable subsidiary ledger and can keep the general ledger free of a tremendous amount of detail. Question 14. What is a journal entry? Answer. In manual accounting or bookkeeping systems, business transactions are first recorded in a journal. Hence the term journal entry. A manual journal entry that is recorded in a company's general journal will consist of the following: the appropriate date, the amounts and accounts that will be debited, the amounts and accounts that will be credited, a short description/memo, a reference such as a check number. These journalized amounts, which will appear in the journal in order by date, are then posted to the accounts in the general ledger. Today, computerized accounting systems will automatically record most of the business transactions into the general ledger accounts immediately after the software prepares the sales invoices, issues checks to creditors, processes receipts from customers, etc. The result is we will not see journal entries for most of the business transactions. However, we will need to process some journal entries in order to record transfers between bank accounts and to record adjusting entries. For example, it is likely that at the end of each month there will be a journal entry to record depreciation. This will include a debit to depreciation expense and a credit to accumulated depreciation. In addition, there will likely be a need for journal entry to accrue interest on a bank loan. This will include a debit to interest expense and a credit to interest payable. Question 15. What is retained earnings? Answer. Generally, retained earnings are a corporation's cumulative earnings since the corporation was formed minus the dividends it has declared since it began. In other words, retained earnings represent the corporation's cumulative earnings that have not been distributed to its stockholders. The amount of retained earnings as of a balance sheet state is reported as a separate line item in the stockholders' equity section of the balance sheet. A negative amount of retained earnings is reported as deficit or accumulated deficit. Question 16. What is the accounting journal entry for depreciation? Answer. The journal entry for depreciation contains a debit to the income statement account depreciation expense and a credit to the balance sheet account accumulated depreciation. The purpose of the journal entry for depreciation is to achieve the matching principle. In each accounting period, part of the cost of certain assets, equipment, building, vehicle, gets moved from the balance sheet to depreciation expense on the income statement so it can be matched with the revenues obtained by using these assets. The account accumulated depreciation is reported under the asset heading of property, plant, and equipment. It is also known as a contra-asset account because it is an asset account with a credit balance. Because accumulated depreciation is a balance sheet or real or permanent account, its balance will carry over to the next accounting period. This means that its credit balance could get as large as the cost of the assets being depreciated. The income statement account depreciation expense is a temporary account. At the end of each year, its balance is transferred out of the account and depreciation expense will begin the new year with a zero balance. It is important to realize that when the depreciation expense entry is recorded, a company's net income is reduced by the expense, but its cash is not reduced. Cash would have been reduced when the asset was acquired. You should also realize that depreciation is an estimate based on the asset's historical cost, not its replacement cost, its estimated useful life, and its estimated salvage value. The focus of depreciation is to allocate and match the cost to expense, and it is not to provide an estimate of the current value of the asset. As a result, the market value of a 1-year-old computer will likely be less than the remaining amount reported on the balance sheet. On the other hand, a rental property in a growing area might have a market value that is greater than the remaining amount reported on the balance sheet. Question 17. What is a credit memo? Answer. One type of credit memo is issued by a seller in order to reduce the amount that a customer owes from a previously issued sales invoice. For instance, assume that Seller Corp had issued a sales invoice for $800 for 100 units of product that it shipped to Buyer Company at a price of $8 each. Buyer Company informs Seller Corp that one of the units is defective and Seller Corp issues a credit memo for $8. The credit memo will cause the following in Seller Corp accounting records: 1. A debit of $8 to sales returns and allowances, and 2. A credit of $8 to accounts receivable. In other words, the credit memo reduced Seller Corp's net sales and its accounts receivable. When Buyer Company records the credit memo, the following will occur in its accounting records: 1. A debit of $8 to accounts payable, and 2. A credit of $8 to purchases returns and allowances, or inventory. Another type of credit memo, also referred to as a credit memorandum, is issued by a bank when it increases a depositor's checking account for a certain transaction. Question 18. What are prepaid expenses? Answer. Prepaid expenses are future expenses that have been paid in advance. You can think of prepaid expenses as costs that have been paid but have not yet been used up or have not yet expired. The amount of prepaid expenses that have not yet expired are reported on a company's balance sheet as an asset. As the amount expires, the asset is reduced and an expense is recorded for the amount of the reduction. Hence, the balance sheet reports the unexpired costs and the income statement reports the expired costs. The amount reported on the income statement should be the amount that pertains to the time interval shown in the statement's heading. A common prepaid expense is the 6-month premium for insurance on a company's vehicles. Since the insurance company requires payment in advance, the amount paid is often recorded in the current asset account prepaid insurance. If the company issues monthly financial statements, its income statement will report insurance expense that is 1/6 of the amount paid. The balance in the account prepaid insurance will be reduced by the amount that was debited to insurance expense. Question 19. What is a contra asset account? Answer. A contra asset account is an asset account where the balance will be either a credit balance or a zero balance. A debit balance in a contra asset account will violate the cost principle. Since a credit balance in an asset account is contrary to the normal or expected debit balance, the account is referred to as a contra asset account. The most common contra asset account is accumulated depreciation. Accumulated depreciation is associated with property, plant and equipment, and it is credited when depreciation expense is recorded. Recording the credits in the accumulated depreciation means that the cost of the property, plant and equipment will continue to be reported. Reporting the accumulated depreciation separately allows the readers of the balance sheet to see how much of the cost has been depreciated and how much has not yet been depreciated. Another contra asset account is allowance for doubtful accounts. This account appears next to the current asset accounts receivable. The account allowance for doubtful account is credited when a company enters estimated amounts as debits to bad debts expense under the allowance method. The use of allowance for doubtful accounts permits a reader to see the documented amounts in accounts receivable that the company has a right to collect from its credit customers. The separate credit balance in the account allowance for doubtful accounts tells the reader how much of the debit balance in accounts receivable is unlikely to be collected. A less common example of a contra asset account is discount on notes receivable. The credit balance in this account is amortized or allocated to interest income or interest revenue over the life of a note receivable. Question 20. What is the three-way match? Answer. In accounting, the three-way match refers to a procedure used when processing an invoice received from a vendor or supplier. The purpose of the three-way match is to avoid paying incorrect and perhaps fraudulent invoices. Three-way refers to the three documents involved: vendor's invoice which was received and will become part of an organization's accounts payable if approved, purchase order that was prepared by the organization, receiving report that was prepared by the organization. Match refers to the comparison of the quantities, price per unit, terms, etc. appearing on the vendor's invoice to the information on the purchase order and to the quantities actually received. After the vendor's invoice has been validated by the three-way match, it can be further processed for payment. The three-way match is an important step in safeguarding an organization's assets.